All right, today we are diving into a really powerful tool for navigating the markets, the average true range, or as you'll usually hear it, the ATR. If you're looking for a better way to get a handle on all that market choppiness, you are in exactly the right place. You know the feeling, right? We've all been there. You're in a great position, everything's going your way, and then, bam, some random crazy price swing knocks you out of the trade. And the worst part? It immediately reverses and goes right back to where you thought it would. It's so frustrating. Well, what if there was a tool to help you actually account for those swings? So here's how we're going to break it all down. First, we'll cover the basics of volatility. Then we'll peek under the hood and see how ATR is actually calculated. After that, we'll look at a real-world example, get into 3 specific strategies you can use, and then wrap it all up by showing you how ATR fits into your broader trading toolkit. Let's get into it. Okay, first things first. What in the world is market volatility? Well, think of it like the market's energy level. Is it kind of sleepy and quiet, or is it totally wild and unpredictable? The ATR, that's basically your personal meter for measuring that energy. So the official definition? It's a technical indicator developed by the absolute legend J. Wells Wilder Jr., and it's designed to do one thing and one thing only: measure an asset's volatility. Now, the key word here is true. And that's because it's way smarter than just looking at the simple high and low of the day, as you're about to see. And this right here is probably the single most important thing you need to burn into your brain about ATR. It's a speedometer, not a GPS. It tells you how fast and erratic the price is moving, but it gives you absolutely zero information about which way it's going. A high ATR could mean a massive spike up or a massive crash down. It just measures the chaos. So what do those speedometer readings actually mean for us? Well, a high ATR tells you you're in a choppy, high-energy market. You can expect big price swings, and that means higher risk. On the flip side, a low ATR signals a quiet, consolidating market. This usually means lower immediate risk, but, it can also be the calm before a really big storm. So how do people actually use this thing? Well, the applications are incredibly practical. It's amazing for setting smarter stop losses that actually respect the market's normal movement. It's also great for spotting when a quiet market might be about to explode, for sizing your positions based on risk, and for sniffing out potential breakouts. All right, let's pop the hood and see how this volatility meter actually works. And listen, don't worry, you're not going to need a calculator or anything. Just understanding the logic behind the tool is what's going to give you a serious edge. The whole thing works in 3 steps. First, for any day, you find what's called the true range. This is the genius part, because it accounts for those price gaps that happen overnight. Then, you just take a simple average of those true range values over a set period, usually 14 days. And finally, a smoothing formula gets applied, which is kind of like a moving average but for volatility itself. It just makes sure the indicator is responsive to what's happening right now. Let's make this real. Looking at this table, you can see the true range is calculated every single day. The very first ATR value, there on day 5, that's just a simple average of the first 5 days. But check out the clever part. See, on day 6, the calculation actually uses the ATR from the day before. That is the smoothing effect in action. It keeps the indicator from getting all jumpy and gives you a much more reliable read on volatility. Now, of course, your trading platform does all this for you in a fraction of a second, but the key insight here is that you now get why ATR is so much better than just looking at a day's range. It's built from the ground up to capture the entire story of volatility, especially those sneaky overnight gaps that can really throw you off. Okay, that's enough theory. Let's see how this actually plays out in the wild with a real-world case study. We're going to take a look at a chart for the energy company Enbridge. So, on this chart, you can see 2 different things happening at the same time. Up top, the price of Enbridge is in a really nice, clear uptrend. But look down below at the ATR indicator. It's actually trending down from a high of about 1.6 all the way down to around 1.08. So, what does that tell us? This quote really just nails it. When you see prices moving up while volatility is going down, that is often a sign of a really healthy, strong uptrend. It means the buyers are firmly in control and the market's getting less chaotic. These quiet periods, these volatility contractions, are often the launch pad for the next big leg up. So the big question is, how do we turn this knowledge into an actual trading edge? Let's walk through 3 actionable strategies you can use with what we just saw on the Enbridge chart as our guide. First up, the classic buy the dip. In a strong uptrend like the one we saw, every little pullback is a potential opportunity. so you can wait for the price to pull back to a key support level. But here's the magic. You use the ATR to set your stop loss. By placing it 1 or maybe 2 times the ATR value below where you got in, you give the trade enough room to breathe. You avoid getting shaken out by all that normal market noise. Okay, strategy number 2 is the volatility breakout. Remember how a low ATR often comes right before a big move? For this, you patiently wait for the ATR to drop to really low levels. That's your signal the market is coiling up like a spring. Then, when the price finally breaks out above the recent highs, you jump in. From there, you can use a trailing stop, maybe 2 times the ATR, to lock in your profits as the new trend takes off. And third, here's one for the long-term investors. For a solid dividend stock like Enbridge, you can use ATR to build your position in a really smart way. The basic idea is to do your buying during these low volatility periods. You can even use the ATR value to help size your position and set a super wide stop loss, say 3 times the ATR, to make sure you can ride out any normal turbulence and just keep collecting those dividends. Now, before we finish up, this is absolutely crucial to understand. As powerful as ATR is, it's a team player. It's not a magic wand. It tells you about volatility, but it really needs some friends to help paint the full picture for you. You should always pair ATR with other tools. For instance, use moving averages to confirm you're trading with the main trend, not fighting it. Use an oscillator like the RSI to check if a move is getting exhausted. And maybe most importantly, always look at volume. A breakout when volatility is low is interesting, but a breakout on high volume and expanding volatility, now that is a powerful, high-conviction signal. So you see, understanding volatility isn't just some abstract theory. It's a real practical skill that can fundamentally change how you manage your risk and spot new opportunities. We've covered what ATR is, how it works, and a few ways to put it into practice. So the real question is, how are you going to use it to your advantage? Thanks for joining me on this explainer.